Welcome to the Deep Dive. Today, our mission is to cut through the noise. We're talking about the sector jitters, the credit anxiety that's been hanging over regional banks.
And we're going to do that by diving into one specific name, Western Alliance Bancorporation, or WAL.
That's right. We're looking at their Q3 2025 earnings call from October 22nd. The stock moved higher right after the release, despite a lot of negative headlines. We want to figure out why.
Yeah, that's the critical question. WAL delivered a huge operational beat, but it was sort of haunted by these very specific credit stories. So we need to look at the numbers, the real underlying results that made the market change its mind, at least for a day.
Okay, so let's start right there with the numbers that grabbed everyone's attention. Walk us through the headline financials.
Well, the initial numbers just, they defied the gloom. GAAP EPS came in at $2.28.
$2.28, and consensus was what, around $2.08?
Exactly, around $2.08. So that's a 20-cent beat. That kind of outperformance, it just signals that something is going very right under the hood.
And the top line, the revenue, that had to be strong to support it.
Oh, absolutely. Net revenue hit $938.2 million. That easily sailed past the street's estimates, which were closer to $88 million.
That's a big beat.
It's a huge beat, and it's a 14% year-over-year increase. But in banking, the real measure, especially now, isn't just net income, it's PPNR, pre-provision net revenue.
Right, PPNR. The engine room. That's the earnings power before you have to account for any potential bad loans.
Precisely, and that's what told us this was an exceptional operational quarter. PPNR hit a record. $393.8 million.
A record.
A record. That's up over $108 million from last year. And you have to think of it this way. PPNR growth is the proof that management is actually managing, controlling costs, growing revenue, no matter what's happening with a few specific loans.
And that strength, that record PPNR, has to translate to the balance sheet. In a sector where everyone is worried about capital, WAL seems to be signaling strength.
They are. They grew their CET1 ratio, that's the key capital buffer, to a very, very solid 11.3%.
11.3. That's well above what's required.
Comfortably. And for you, the investor, the number that really matters is tangible book value per share. That jumped 12.7% year over year, hitting $58.56.
And that kind of TBV growth shows they're not just, raising capital and diluting shareholders to grow. It's profitable growth.
It's quality growth. And that capital strength is the context you need before we can even talk about the credit issues.
Okay, let's get into the drivers then. You don't hit record PPNR by accident. I think the most surprising part of the quarter was the funding side, the deposits.
The funding was just a massive inflow. Deposits surged by $6.1 billion in one quarter.
$6.1 billion.
Billion. That's 8.6% growth. It brought their total deposit base to $77.2 billion. And it wasn't just one thing, it was diversified. Mortgage warehouse, regional banking, and especially their specialty escrow services.
So a deposit tsunami. What does a bank do with $6 billion of relatively cheap funding that just walks in the door?
Well, they prioritize liquidity first. The loan-to-deposit ratio dropped way down to 73.3%.
73%. So they're swimming in cash.
They are, which is a good problem to have. And then second, they used $2.2 billion of it to pay down their borrowings.
And that's the quiet hero of the earnings beat, right? Paying down expensive debt immediately helps your net interest income.
Immediately. Cheaper funding flows right to the bottom line. Their NII grew $53 million quarter over quarter to $750 million. And here's the kicker. Their net interest margin, their NIM, held stable at 3.53%.
Stable. But the Fed started cutting rates toward the end of the quarter. That should compress margins. How'd they pull that off?
It's a funding story. Their overall liability costs actually compressed by 8 basis points. It was because they paid down those expensive borrowings and because of growth in their ECR-related deposits.
Okay, hold on. ECR, earnings credit rate. Let's break that down for people who aren't deep in the weeds on bank balance sheets. What is that?
Right. So ECR deposits are held by commercial clients. Think treasury services. Instead of paying cash interest, the bank gives the client an earnings credit that offsets the fees they pay for those services.
So it's like a barter system for interest?
Sort of. And as market rates fall, the bank has to give a smaller credit to offset those same fees. It effectively makes those deposits less sensitive to rate cuts than a normal savings account. That's a huge structural advantage.
Got it. Okay, let's pivot from interest income. The other side of the coin was non-interest income. It looks like their mortgage business, AmeriHome, is finally waking up.
It really is. Non-interest income jumped nearly 27% in the quarter, and most of that was a $17 million increase from mortgage banking.
And why now?
Management pointed to three things. 1, improving home affordability. 2, lower mortgage spreads. And 3, a big pickup in demand for adjustable rate mortgages, or ARMs, which are very profitable.
And they gave a very specific data point on that, didn't they? Something about the 30-year fixed rate.
They did. They said activity really takes off when the 30-year is in the low sixes. And on the day of the call, it was at 6.15%. So that Fed relief is a direct, tangible tailwind for them.
And beyond the revenue, this all points to efficiency.
Huge efficiency gains. The adjusted efficiency ratio dropped below 50%, down to 48%. That's what we call positive operating leverage. Revenue is just growing much faster than expenses.
So record PPNR, massive deposit inflows, mortgage business roaring back. It sounds perfect.
Yeah.
But none of that matters if the loan book is a disaster. This brings us to the credit conversation that dominated the Q&A.
Yeah, they had to go on the offensive here. The provision for credit losses, the money they set aside for bad loans, it jumped to $80 million.
And that was the headline that scared people. Why the big jump?
It was almost entirely due to one specific issue, a $30 million reserve against a $98 million non-accrual loan. This was the Cantor Group V credit that everyone was talking about.
Right. And the story there wasn't just a bad loan. Management was alleging fraud.
That's the key. They alleged the borrower violated the credit agreement by being junior to other lenders. It was a breach they called fraud. And to calm investors, they pointed to 3 layers of protection.
Okay, what were they?
First, they confirmed they have collateral coverage. Second, they have $25 million in specific mortgage fraud insurance. And third, they have unlimited springing guarantees from ultra high net worth individuals.
So they're saying they expect to be made whole on that $98 million.
They were very confident on the call. Their point was, this is isolated. This is bad behavior by one borrower, not a failure in our underwriting process.
Okay, that's one. But there was another one. The Point Bonita Fund 1 loan, $168 million in their asset-based lending book. What was the concern there?
The concern was just, general anxiety about any commercial loans. But management was absolutely firm. They said that loan is current. They are getting paid principal and interest.
And the collateral.
The collateral is the story. It's backed by $890 million in accounts receivable from top-tier investment-grade retailers.
Wait, $890 million in receivables for a $168 million loan?
You got it. It's a loan-to-value of under 20%. The receivables are from companies like Walmart and AutoZone, so the risk is incredibly low. They used it as a prime example of their conservative underwriting.
So if you step back from those two very specific, very noisy issues, what did the rest of the loan book look like?
It actually got better. Total criticized assets, so loans showing any sign of weakness, they actually declined by almost $200 million in the quarter. And net charge-offs were super low at just 0.22%.
So the message was, the stress is contained. It's not spreading.
Contained and concentrated. And it seems like by the end of the call, the market was starting to believe them.
Let's shift to the future then. Guidance and strategy. After a quarter like this, what do they tell the market is next?
They raised guidance pretty aggressively, which signals confidence. They upped their full-year deposit growth expectation from $5 billion to $8.5 billion.
Wow.
Yeah. And they held their NII growth outlook steady at a strong 8 to 10% for the year.
But the most aggressive signal, I thought, was the capital return plan, the buyback.
It was a very loud signal. They authorized a $300 million share repurchase program. And what's really interesting is they said they're looking at issuing some subordinated debt to accelerate those buybacks.
Which basically means they think their stock is so cheap right now, it makes sense to borrow money to buy it back.
Exactly. It's a huge vote of confidence in their own tangible book value. They see it as deeply undervalued.
And they're clearly not slowing down as they approach that $100 billion asset mark. Where's the growth coming from?
It's coming from their specialty businesses, the non-lending stuff. Specialty escrow brought in $1.8 billion in deposits this quarter alone. And their corporate trust services, this was an amazing statistic. In just 2 years, they've become the 7th largest CLO trust depository in the world.
The 7th largest, globally.
Globally. And they pair that with their corporate lending. They called it a powerful 1-2 punch. It brings in sticky, high-quality deposits.
Okay, so that's the strategy. What's their view on the macro, on interest rates?
They're modeling for 25 basis point rate cuts right after the call, and then another one in December.
And that forecast is important because
Because it supports the mortgage banking recovery we talked about.
Yeah.
And it also informs their assumptions about deposit costs. They're expecting what's called a 70% loaded deposit beta on their ECR deposits.
Okay, translate loaded deposit beta for us.
It just means they expect that as the Fed cuts rates, they'll only have to pass on about 70% of that cut to their specialized clients. They get to keep the other 30%. That control is what helps them keep their net interest margins stable, even in a falling rate environment.
So with all this liquidity, their loan-to-deposit ratio is down at 73%. Management said that's actually a little too low for them.
Yeah, that's right. They're actively hunting for good loans to put that money to work. They're not shrinking. They're building out their infrastructure to be ready for when they cross that $100 billion regulatory threshold. They're playing for scale.
Okay, this brings us to our final segment, the part where we pitch an outrageous but plausible trade idea based on everything we've just discussed. And as always, this is not financial advice.
A disclaimer everyone should take to heart.
Our high-conviction, high-risk trade idea is long wall. The bet is on a rapid multiple expansion. The thesis is really simple. The market is pricing this stock based on old, isolated credit fears. It should be pricing it on record operational strength, on PPNR.
And the setup for this trade is all about what management is doing with its own money.
Exactly. The decision to accelerate that $300 million buyback, maybe even funding it with new debt, it just screams that they think the stock price is wrong. It's temporary.
And they even told us what price they were buying at.
They did. They specifically said on the call they were buying back shares around $77.83 after the credit news hit. That's a verifiable arbitrage opportunity for the bank itself, and investors can essentially ride their coattails.
So the risk, the $30 million reserve, is known, but the upside from operations and capital return is still being ignored.
That's the trade. The downside is known and reserved for. The unknown upside is the reacceleration of that AmeriHome mortgage business into 2026, plus this aggressive buyback. Together, that should deliver industry-leading returns and compound that tangible book value. You just have to believe the credit risk is truly isolated.
So to recap the essential nuggets here, Wall delivered a commanding PPNR and EPS beat. It was fueled by incredible deposit growth and a clear recovery in mortgage, and they did it all while aggressively walling off two specific credit problems.
Which brings us to our final provocative thought for you to chew on. Management is leaning hard into growing their specialty businesses, like corporate trust and fund banking. These are often called non-deposit funding institutions, or NDFI, businesses.
Right, and the market tends to see that as a risk factor.
Exactly. But given the historically near-zero loss rates in key parts of that business, like mortgage warehouse lending, is Wall's higher exposure to these NDFIs actually a structural competitive advantage and not the risk everyone thinks it is? It invites you to think not just about the quantity of these assets, but the actual quality and low-risk nature of the business they're building.